30 seconds. That's all it takes for trillions of dollars to move across the world. In less time than it takes you to finish this sentence, global markets can gain billions, or lose everything. But here's the unsettling part. Almost nobody truly understands the system that moves this money. Not politicians, not most bankers, and definitely not the public. Behind the simple idea of money moving around the world exists a vast hidden structure, a quiet architecture that decides how economies rise, how companies expand, and sometimes, how entire countries collapse. It's not a conspiracy, it's not secret, but it is incredibly complex, and the people who understand it hold extraordinary influence over the global economy. Today, we're going to pull back the curtain and explore the hidden architecture of global finance, simply, calmly, and step by step. Because once you see how this system is built, the world's economic headlines will suddenly make much more sense. And you'll realize something surprising. Global finance isn't random, it's engineered. Let's start with a simple idea. Money, by itself, doesn't do anything. A dollar sitting in a wallet does nothing for the economy. It only matters when it moves. Movement is what creates the global financial system. When you deposit money into a bank, that bank doesn't just store it safely like a vault in an old movie. Instead, your money becomes part of a larger pool. Banks lend that money to businesses, homeowners, governments, and investors. Those borrowers use it to build houses, launch companies, hire employees, and create products. And as those activities happen, money flows again. Salaries are paid, goods are bought, investments are made. At first glance, it seems simple. But when this process happens across thousands of banks, millions of businesses, and hundreds of countries simultaneously, the system becomes incredibly complex. Think of it like a giant global circulatory system. Money is the blood, banks are the arteries, and financial markets are the beating, heart-pushing capital around the world. Every second, trillions of dollars move through this network, and most of it happens digitally. No cash, no physical movement, just numbers traveling across financial networks. Now here's where the hidden architecture begins. Most people imagine banks as the center of global finance, but banks are only one layer. Above them sits something far more powerful: financial markets. Markets determine the value of currencies. They determine interest rates. They determine how much it costs for businesses and governments to borrow money. And markets react instantly to information. A single news headline can move billions of dollars within minutes. But markets themselves are not centralized. There is no single building controlling them. Instead, they operate through a web of exchanges, institutions, algorithms, and global investors. New York, London, Tokyo, Singapore, Hong Kong. These financial centers operate almost like relay stations for global capital. When trading ends in one region, it begins in another. The global market never truly sleeps. Inside these markets, different types of financial assets are constantly traded. Stocks represent ownership in companies. Bonds represent loans made to governments or corporations. Currencies represent national economic strength. And derivatives represent financial contracts based on the future value of those assets. This is where the system becomes more abstract. Because much of modern finance isn't about physical goods anymore. It's about expectations. Investors constantly ask questions like, will interest rates rise? Will inflation increase? Will this company grow? Will this country remain stable? The answers to those questions influence where money flows next. Now imagine millions of investors making those decisions simultaneously. Pension funds, managing retirement savings. Investment firms controlling trillions of dollars. Hedge funds searching for small advantages. Central banks monitoring economic stability. Each one moves money based on different goals. And together, their decisions shape the global financial landscape. This is why markets sometimes appear unpredictable. But underneath the surface, they follow patterns driven by incentives, risk, and information. At the core of this system sits something even more important: trust. Global finance only works because people believe the system will function tomorrow the same way it does today. When a government issues bonds, investors trust that government will repay the debt. When banks lend money, they trust borrowers will repay loans. When countries trade currencies, they trust those currencies will hold value. If trust disappears, the entire system begins to shake. And history has shown us what happens when that trust breaks: financial crises. Think back to 2008. For years before the crisis, Banks created complex financial products built on home loans. These products were traded globally. Investors believed they were safe, but underneath, the structure was fragile. When homeowners began defaulting on mortgages, the entire network started collapsing. Banks stopped trusting each other. Credit froze. Markets crashed. Within months, the global economy was in the worst financial crisis since the Great Depression. What made the crisis so dangerous wasn't just the losses. It was the sudden loss of confidence in the financial architecture itself. And that showed the world how interconnected everything had become. Since then, governments and regulators have tried to strengthen the system. Banks now hold more capital. Financial institutions face stricter oversight. Risk models have improved, but the architecture itself hasn't fundamentally changed. In fact, it has grown even larger. Today, global financial assets are worth hundreds of trillions of dollars. That's far larger than the entire global economy, which means finance now operates at a scale that few people fully comprehend. Another key piece of this architecture is something most people rarely think about: central banks. These institutions sit quietly behind the scenes, but they play one of the most important roles in global finance. Central banks control monetary policy. They set interest rates, they regulate banking systems, and during financial crises, they act as lenders of last resort. In the United States, this role belongs to the Federal Reserve. In Europe, it's the European Central Bank. In Japan, the Bank of Japan. In China, the People's Bank of China. Each central bank manages its own country's financial stability, but their decisions ripple across the entire global system. If the Federal Reserve raises interest rates, global investors immediately react. Money might move from emerging markets back into the United States. Currencies shift, stock markets adjust, loan costs change. A single policy decision can influence trillions of dollars worldwide. And over the past decade, central banks have taken on even greater power. After the 2008 crisis, many began using a policy called quantitative easing. Instead of simply adjusting interest rates, central banks started buying massive amounts of government bonds and financial assets. This injected enormous amounts of liquidity into financial markets. The goal was simple: keep the financial system stable, encourage lending, support economic recovery. But this also created a new reality. Financial markets began relying heavily on central bank support. Whenever markets fall sharply, investors often expect central banks to step in. Some analysts even refer to this as the central bank safety net. But there's another force quietly reshaping global finance: technology. Just 20 years ago, most trading decisions were made by humans. Today, algorithms dominate large portions of financial markets. These computer programs analyze enormous data sets in milliseconds. They execute trades faster than any human could react. High-frequency trading firms use powerful systems to buy and sell assets thousands of times per second. This has dramatically increased market speed and efficiency. But it has also introduced new risks. Sometimes algorithms interact with each other in unexpected ways. When that happens, markets can experience sudden, dramatic price swings. Events like the flash crash of 2010 revealed how quickly automated systems can move billions of dollars within seconds. And this technological shift is still accelerating. Artificial intelligence is beginning to influence financial analysis. Machine learning models evaluate credit risk, predict market trends, optimize investment portfolios. The architecture of global finance is becoming more digital, more automated, and more interconnected every year. Which raises an important question: who truly controls this system? Is it governments, banks, investors, algorithms? The answer is complicated. No single entity controls global finance. Instead, it's a decentralized network shaped by countless participants. But some institutions undeniably hold more influence than others. Major investment firms manage trillions in assets. Large banks connect global capital flows. Central banks steer monetary policy. And global organizations like the International Monetary Fund monitor financial stability. Together, they form the pillars of the financial architecture that supports the modern economy. Yet despite all this complexity, the goal of the system remains surprisingly simple: allocate capital. Move money from places where it sits idle to places where it can create growth. Fund new technologies. Build infrastructure. Support businesses. Enable trade between nations. At its best, global finance fuels progress and opportunity. But when the architecture becomes unstable, the consequences ripple across the world. Jobs disappear, savings shrink, entire economies slow down, which is why understanding this system matters more than ever. Because whether we realize it or not, every person participates in global finance through savings accounts, retirement funds, loans, credit cards, investments. Even the price of groceries can be influenced by currency markets and global supply chains. And the truth is, we're only beginning to understand how powerful this architecture has become. Over the next decade, the system will likely undergo some of its biggest transformations yet. Digital currencies, AI-driven markets, new financial power centers, shifting global alliances, all of these forces are quietly reshaping how money moves around the planet. The architecture is evolving, and the next chapter of global finance may look very different from the one we know today. But to understand where it's going, we first have to examine the deeper layers of the system, the institutions, networks, and mechanisms that keep the entire structure operating behind the scenes. And that's exactly what we're going to explore next. If you enjoyed this breakdown and want to see more simple explanations of complex global systems, make sure to like this video, share it with someone curious about how the world really works, leave a comment with your thoughts, and subscribe for more deep dive documentaries like this one. When people hear the phrase global finance, they often imagine massive banks or powerful investors sitting behind giant desks deciding where money should go. But the deeper reality is far more intricate. Global finance operates more like an enormous invisible machine, a system made up of institutions, agreements, digital networks, and rules that quietly coordinate how money moves between countries. And much of this system was not designed all at once. It evolved over decades, sometimes intentionally, sometimes as a reaction to financial crises. To understand how the hidden architecture works, we have to look at the structural pillars that support it. One of the most important pillars is international payment infrastructure. Every day, millions of transactions move across borders. Companies pay suppliers. Governments buy resources. Investors move funds between markets. But international payments are not as simple as transferring money between two bank accounts. Different countries use different currencies, different banking systems, different regulations. So a specialized network exists to coordinate these transfers. One of the most important systems in this network is the global financial messaging infrastructure used by banks to communicate with one another. When a bank in New York sends money to a bank in Tokyo, it doesn't physically move dollars across the ocean. Instead, digital instructions travel through secure financial communication networks. Banks update their internal ledgers. Balances shift. And within minutes, the transaction is completed. This invisible infrastructure quietly processes trillions of dollars every single day. Without it, global trade would slow down dramatically. But payment systems are only one layer. Another critical component of global finance is the bond market. If the stock market represents ownership in companies, the bond market represents borrowing on a massive scale. Governments borrow money by issuing bonds. Corporations borrow money the same way. Investors buy these bonds and receive interest payments over time. In simple terms, bonds allow large institutions to raise huge amounts of money quickly. The scale of this market is enormous. Global bond markets are worth tens of trillions of dollars. In fact, they are significantly larger than global stock markets. This means that government borrowing plays a massive role in shaping the financial system. When a country issues bonds, it is essentially asking global investors to trust its future. If investors believe the country is stable, they lend money at low interest rates. If they believe the country is risky, borrowing becomes much more expensive. This creates a powerful feedback loop. Countries that manage their economies well can borrow cheaply. Countries that lose investor confidence face rising borrowing costs, and sometimes financial crises. History provides many examples: Argentina, Greece, Turkey. Each faced periods where investors suddenly lost confidence in their ability to repay debt. When that happens, capital flows out quickly. Currencies weaken, markets become unstable. This demonstrates another key truth about the architecture of global finance. Capital moves extremely fast, much faster than governments can respond. Technology has accelerated this speed dramatically. Today, investors can move billions of dollars across borders in seconds. That mobility gives financial markets enormous influence over national economies. But the architecture doesn't rely only on markets. Global financial stability also depends on international cooperation. Several organizations exist specifically to monitor and support the system. One of the most important is the International Monetary Fund. The IMF was created after World War II to stabilize the global financial system and assist countries facing economic crises. When countries experience severe financial trouble, currency collapse, debt crises, or sudden capital flight, the IMF can step in with emergency loans. But these loans usually come with conditions. Governments may need to restructure their economies, reduce deficits, or implement financial reforms. Supporters argue these programs restore stability. Critics argue they sometimes impose harsh economic adjustments. Regardless of perspective, institutions like the IMF play a central role in maintaining the architecture of global finance. Another important institution is the Bank for International Settlements. Many people have never heard of it, yet it acts as a kind of central bank for central banks. Located in Switzerland, this organization coordinates cooperation between the world's major central banks. It also helps develop international banking regulations. These regulations are crucial because banks operate globally. Without common rules, financial institutions could take excessive risks in one country that affect the entire system. That's why global banking standards exist. They establish requirements for how much capital banks must hold, how much risk they can take, and how they manage financial stability. These rules form part of the hidden framework that keeps the system functioning. But there's another dimension of the architecture that is becoming increasingly important: global capital flows. Capital constantly moves between countries in search of opportunity. Investors look for growth, higher interest rates, stable political environments. When they find attractive opportunities, they move funds into those markets. This can strengthen local currencies and stimulate economic activity. But the reverse can also happen. If investors become nervous about a country's economy, they may quickly withdraw their money. That sudden outflow can weaken currencies, reduce investment, and create financial pressure. Emerging markets often experience this cycle. Periods of rapid investment followed by sudden capital flight. This volatility highlights one of the biggest challenges of global finance. Balancing openness with stability, countries want foreign investment. But too much dependence on global capital can create vulnerability. That's why some governments use capital controls, policies designed to limit how quickly money can enter or leave their economies. Another layer of the financial architecture involves reserve currencies. Certain currencies play a special role in the global system. The most important of these is the United States dollar. For decades, the dollar has functioned as the primary global reserve currency. This means central banks around the world hold large amounts of dollars as part of their foreign exchange reserves. International trade is often priced in dollars. Oil markets operate largely in dollars. Many international loans are issued in dollars. This gives the United States enormous influence within the financial system. Because when the Federal Reserve changes monetary policy, the effects spread globally. But the system may be evolving. Some countries are exploring alternatives. The euro plays a growing role in international finance. China has been promoting the international use of its currency, the renminbi, and digital financial technologies could introduce entirely new forms of global money. One of the most talked about developments is the potential rise of central bank digital currencies. These are digital versions of national currencies issued directly by central banks. Unlike cryptocurrencies, they would be backed by governments. Some countries are already testing them. If widely adopted, these digital currencies could transform payment systems, financial inclusion, and international trade. They might also reshape the architecture of global finance itself. Because digital currencies could allow faster cross-border payments, reduce transaction costs, and potentially challenge the dominance of existing reserve currencies. At the same time, they raise new questions. How will privacy be protected? How will cybersecurity risks be managed? How will international financial rules adapt? These questions remain unresolved. But one thing is clear: the financial architecture is not static. It is constantly evolving. Technology, politics, economics, and global cooperation all influence how the system changes over time. And as the system evolves, new power centers may emerge. For much of modern history, financial influence was concentrated in a few Western financial capitals: New York, London, Frankfurt. But today, other cities are gaining importance: Shanghai, Singapore, Dubai. These centers are expanding their roles in global capital markets. And as economic power shifts globally, financial influence may shift as well. All of these forces are reshaping the structure of global finance, yet the basic purpose remains the same. Connect savings with investment, move capital where it can create economic growth, enable trade between nations, and support the functioning of the global economy. But as the architecture becomes larger and more complex, one challenge continues to grow: transparency. Most people interact with the financial system every day without understanding how it works. They take loans, use credit cards, invest retirement savings, pay taxes. All of these actions connect individuals to the global financial network. Yet the underlying mechanisms remain largely invisible. That's why conversations about financial literacy are becoming more important. Understanding how the system works helps people make better financial decisions. It also helps citizens understand economic policy debates, interest rates, government debt, inflation, currency stability. These topics often dominate headlines. But without understanding the architecture behind them, it's difficult to see the full picture. And the truth is, the architecture of global finance will likely become even more influential in the years ahead. Artificial intelligence may increasingly guide investment decisions. Digital currencies could reshape payment systems. Geopolitical tensions might fragment parts of the financial system. Or new cooperative frameworks could emerge to stabilize global markets. The future is still being written, but one thing is certain: the invisible structure that moves money around the world will continue shaping economies, politics, and everyday life in ways most people rarely notice. Because global finance isn't just about banks or markets, it's about the flow of opportunity, the allocation of resources, and the quiet mechanisms that determine how economic power spreads across the planet. Once you begin to see that architecture, financial news starts to look different. Market movements make more sense. Policy decisions carry deeper meaning. And the global economy no longer feels like a random series of events. It becomes a system, a structure, an evolving machine connecting billions of people through the movement of capital. And understanding that system is one of the most valuable insights anyone can gain in the modern world. If you found this explanation helpful and want more calm, simple breakdowns of complex global systems, make sure to like this video, share it with someone curious about how the world really works, leave your thoughts in the comments, and subscribe for more deep dive documentaries just like this one.